Welcome everyone to the next episode of Cut the Curve. I'm Philip Zweig, and today I have with me a friend of mine, someone I've known for years, Noah. He's president of Capital Fund One.
Correct.
Awesome to have you here today, Noah. Thank you.
Yeah, thanks for having me.
I've been in the game now 23 years. I've flipped over 1,000 properties here in Arizona. Things have always evolved and changed, so that's my background. Right now, I'm currently 2 years into the Airbnb journey, and then we started Cut the Curve to interview moguls, mentors, and entrepreneurs, and Noah fits all those, so thank you for joining us today.
Yeah, absolutely.
Throughout the show, we're going to talk to Noah about what he has done since getting involved in the real estate space, and then also 3 takeaways that he's going to give you guys as far as tips, tricks, shorten your length of learning. There's a lot of different things you could do in real estate, and hard money lending is a giant industry today.
Yes.
So, Noah, how did you start in your, traditional path? You said you went to college, and then what did you do right after college?
Yeah, so I'm an Arizona native, grew up here, went to school and graduated from Scottsdale Christian, then went to school over in California, California Lutheran University, played Division III basketball there for
Oh, sweet. I didn't know you were a basketball player. We'll get along.
Yeah,
absolutely. Got the Bulls court in the backyard.
Yeah, love it. Yeah.
What position? Guard?
Shooting guard. Yeah,
Okay.
I just ran around and shot 3-pointers.
Nice.
So that was
Steph
fun.
Curry.
Yeah, exactly. Yeah, so did that, came back to Arizona after I graduated, failed miserably at trying to sell insurance for about a year and a half. Like we talked about, I realized I wasn't good at talking to people about the last thing in the world they want to talk about. So then got into real estate in 2004, worked with a friend who I'd gone to high school with and his dad who had been a land developer for about 30 years. So we did some land development deals up in North Scottsdale, down in Pinal County. So did that from 04 to 07, then had an opportunity to go work for a commercial developer as a development manager, so worked for Panettone Development here in town. From 07 to 09, we did 5 industrial developments throughout the valley, so that was good. Got to learn about the construction side and the commercial side a lot. And then obviously music kind of stopped in 09. They shut the office down, and then I came back and hooked up with Justin and Mike, who had started buying some properties at the trustee sale auction, doing fix and flips, so they needed some help. So we ended up doing 20 or 25 fix and flips. And then we were down at the courthouse, we met some investors that needed some capital for some deals. So we made a couple loans, then just decided to focus on the lending business and just kind of grown it from there.
Amazing. So that insurance job right out of college, what did that teach you as far as we've all had those first jobs, I sold copiers, like I was telling you, and got beat up almost every day. Even though everyone needs a copier, they're like, oh, we just saw another copier salesman.
Yeah.
So what did that teach you? How did you decide to do insurance after getting your bachelor's degree?
Yeah, so I really didn't know what I wanted to do. Like a lot of people.
Yeah.
And the company Thrivent Financial had some on-campus interviews. I knew some of the people that worked there, so I figured I'd give it a go, but yeah, I realized that.
How long did you do that?
So that was about a year and a half.
Yeah, that's
so
a lot lasted.
Yeah, a lot of cold calls, a lot of calling people that had policies, and I realized I didn't take rejection so well. Getting hung up on, and I'd stare at the phone and think, all right, got to pick it back up. But yeah, it was good. I definitely learned.
Taught you.
Yeah, sometimes it's good to learn. What you like and what you don't like, and I definitely
I like that
kind of
sure.
helped learn in that.
Because as young 21, 22, I never, I had part-time jobs, but now this is a whole new thing that's opened up. What do you do if you're not a specialty doctor, lawyer? So
exactly.
You got into that, and then your buddy, he directed, did you know anything about real estate when you got into the land development as your first real estate
Yeah, I'd always been interested in real estate. You know, I hadn't really worked in real estate, but always had an interest. And yeah, just talking to my buddy who was my roommate at the time, just about what he was doing, and he just said, "Hey, you gotta stop trying to sell insurance because it's not going so well. You should come join me."
Yeah.
And I liked it, and I jumped at the opportunity.
So what I'm hearing Noah say is you had a mentor right out of the box for real estate with
Yep.
his dad being in the business 30 years, and
Yep.
that I'm sure gave you that sense of security, but you still got to hustle and prove yourself, right?
Yep. Yeah, absolutely. Yeah, it's great. I mean, it's important to have a mentor for sure to learn from. I mean, a lot of times, you know, especially as a younger person, you kind of got to make your own mistakes and learn through that. But it's nice to have somebody to, you know, make sure you're not making a life-altering mistake.
For sure, for sure. So similar to you, I met Jerry, who's changed my life as far as a mentor.
Yeah.
He started when he was 30, he retired at 50. I'm like, holy cow, that's pretty amazing. So he had 20 plus years experience, and I was doing it in the late 90s. I met him around 2004 also. When I met Jerry, my business just went through the roof because he was a proven, he failed, he succeeded, he went through 2 or 3 recessions. So that tremendously helped me just feel, I had to make the mistakes, but he would guide me on like you said, giant mistakes where you could lose everything and stuff of that nature. So
absolutely.
that's what we're saying. Get a mentor. If you don't have one, you could learn on your own, but it's going to take you, I don't know how long to try to figure out the game yourself.
Yep, absolutely.
So you got into it. Was it everything you thought it was, or like what was the day-to-day stuff with land development? Because you said you would buy like 5 acres or 5 parcels, or? Yeah,
I mean, it was, again, I learned a lot. So yeah, typically we were doing a bunch of stuff up in Rio Verde.
Okay.
Kind of in that county island in North Scottsdale. So we'd you know, try to identify sellers. You know, we did a lot of mailers, knocked on doors, all that kind of stuff, just to find people that were interested in selling. And obviously, you know, in real estate, you make your money when you buy it. So try to negotiate the best deal, you know, most favorable terms as possible. And then depending on the zoning and what we could do, we'd split the parcel into smaller pieces. And, you know, typically you can sell, you know, we'd buy by the yard and sell by the foot. So you can sell a little bit of a,
premium. Interesting. So there is a lot of county islands throughout Arizona, and I've never flipped on a county island, but I always wondered about how the value, what you could do, because you could really do some big things, it sounds like, with that.
Yeah, it's a little bit more flexible, a little bit easier to do lot splits and things like that. So yeah, it was a good opportunity. We made some money doing that. And then, like I said, that area kind of dried up a little bit, and, you know, call it 06. I mean, values were going through the roof. So then went down to Pinal County, Casa Grande, and Maricopa.
Okay. So it sounds like you guys were ahead of the curve, because there wasn't as much people out in Casa Grande. Now it's exploded, but I mean, in 06, was there any I'm sure there was competition, but probably not the way it is today.
Yeah, there was definitely some competition, but you're right. It just, you know, buying and selling land wasn't as popular back then, and, you know, some people aren't comfortable with land, and fortunately I had a good mentor to, you know, kind of teach me the different things that I need to look out for. So yeah, there's definitely.
So you guys were making money. Did you have any? I mean, I know I did when I was flipping. Like I did it. Like I told people before, I did in Canto. I did a flip down there on by the fairgrounds in Phoenix 19th. It was a historic district, but I didn't do it the right way. I did it like it was a tract home, so I lost money there. Did you have any losses during your?
Yeah, I mean, definitely. You know, did well up in Rio Verde. Did a couple deals down in Casa Grande. Then bought a deal in Maricopa in, man, I think it was like late 06, early 07.
Okay.
So the music was starting to stop. It hadn't completely stopped yet. So yeah, that was one that I had to work through.
And you had to figure it out, right?
Yeah,
Like,
I got a
and
seller carry on it. I put a down payment down, so I had to go back to the seller and renegotiate, give him back a portion of the land, got some credit for the money I'd put down, so I kept a 5-acre piece. But, just to put it in perspective, I think I bought that land for $30,000 an acre and just finally sold the 5-acre piece, 15 years later for like $12,000 an acre. So land obviously went a little crazy pre-Great Recession.
yes, yes.
So yeah, but worked through it.
But that's what I love about real estate, and if you have good mentors on your team, you could learn from them and figure things out. It's like It's not the end of the world, so you could work through it and think long term versus short term is what I was always taught. So 15 years later, you're
in any challenging situation, it's an opportunity to learn and grow. So so that's definitely something people gotta keep in mind. I mean, if something doesn't go as planned, don't freak out. Just sit down and figure out how to work through it, because there's always a way to work through things.
There is, and again, the challenges. If you're in the game, you're going to get hit with challenges, just like when you're playing basketball or whatever. The defense is shifted, so you have to adjust your game. The coach has to adjust the game plan, like zone and
Absolutely.
Hey guys, quick announcement. I just launched my new Passive Income Accelerator course. In this course, you'll learn how I built my Airbnb portfolio to 10 properties and growing while amassing $3,000 to $5,000 per property per month. If you want to learn more, go to piaaccelerator.com/go and sign up for the early bird special. And now back to the podcast. So real estate's very similar. If you're an athlete, like how do we adjust? And the market changes too, because I remember in '07, these developers wanted to sell us like these track models, and then we would lease it back to them in Maricopa. But my mentor Jerry, he's like, let's think about it, because these were like 400,000 brand new homes. They would have them as their models, they would work, and then we would buy them and they would lease it back. But thankfully we decided against that one. That was probably '06, '07.
Right, yeah.
And then the unthinkable happened. And, '08, we had all these rentals. We were with Washington Mutual, and
they no longer exist.
They no longer exist, and they would not help us. They would not help us during that '08, '09. They're like, so eventually we had to, I think we had a portfolio of, we did almost 50 rentals, and everything we had to get back. And bro, that was like painful.
Painful, yeah, for sure.
So learning experience though, and we're still here, 12, 13 years later. So we grew through it. And so '08, '09, you were down at the trustee sale, you said, Noah?
Yeah, so we were buying properties down at the trustee sale.
During the recession or after?
So we started in like late '08, early '09.
Okay.
So kind of, in hindsight, right at the bottom.
Gotcha.
So we were buying properties and doing fix and flips ourselves. So
you were probably buying 20, 30 cents on the dollar?
Oh yeah. I mean, I remember you could go to Maryvale and basically point out any house, and it was 25, maybe 30 grand.
Yes.
You could buy anything you wanted.
I know. Shout out to Chris Hughes. I don't know if you know Chris, Frank Berry, like those guys ate that stuff up down there.
Absolutely. So we were buying kind of all over the place, but while we were down there, we met some other investors that needed some capital for some properties that they had purchased. So we made a couple loans.
Because no one had money. Well, at least I didn't have money. And then it felt like all the investors from the U.S. Didn't have anything. So Canadians helped me greatly when they came in our market.
Yeah. So there was a few hard money lenders that had a little bit of money that they were lending, but there wasn't enough based on the amount of activity that was going on at the trustee sale with all the foreclosures.
Yeah.
So we just identified the opportunity, and Mike Anderson, the founder of the company, had about $2 million that we were working with doing the flips. and then we just started moving that over to the lending business. Made a handful of loans. Felt like the business had legs, so we created our fund back in 2009, and then started reaching out to friends and family to raise capital to grow the business.
So when you were flipping during that period, because I wasn't flipping, I had to take a 3-year hiatus to get money, and I leveraged that to help Canadians. So I taught a lot of Canadians how to invest. But so say you bought a house for $30,000, and you know, we all know Maryville in Arizona, but if you're not from Arizona, it's really a older community, maybe built in the 50s by John F. Long. I mean, there's
working class neighborhood.
Working class neighborhood.
Yeah, but good location right off the 10, right off freeways. So
bread and butter properties, built really well. Probably, I don't know, I think the biggest was like 1,600 square feet model, and then people would just add on additions and stuff. So who was actually buying those properties back in like 08, 09, 2010?
Yeah, at that point it was really just mom and pop investors. So groups like ourselves that had a little bit of money that we were working with, you know, maybe if they had relationships with hard money lenders, they could leverage that a little bit. But yeah, there's, you know, a lot of people down there, you know, Chris Iman and Rob Binkley and all those guys, Jeff Howard and John Ray. We used Jeff and John's bidding service. So yeah, there was a decent amount of people down there that were either buying for themselves or buying for clients. So when you
sold those, were they selling at like 60, 70,000, or what were you getting on?
Yeah, so if I remember one deal, I think we bought the house for 25 grand, put 15 or 20 grand into it, and then sold it for, I think, 85, 90,000. Okay. So there were some healthy margins on properties back in the day. And we kind of knew what we were doing. We'd go in and put a budget together, and as usual, you know, completely bust it and decide we wanted to do different things. But fortunately, the spreads were healthy, so you could make a mistake back then and still make some profit.
Money on your flips. Flipping's changed quite a bit since then. That area today, holy cow, what are they getting on those?
I remember in Jamil's in the first season of his show, I think it was a 1,600 square foot house that they sold for like $397. So that same house we would have sold for 80 or 90 grand. If they're now selling for 400 grand.
400,000 down there.
Yeah,
that's amazing.
Yep.
So you saw this opportunity. It sounds like in the private lending space, because when I first started in the late 90s, like there wasn't as many. Yeah. I mean, there was a handful, I'd say. So there were private money, family money, whatever. Yep. There wasn't the industry has exploded today.
Yeah, absolutely.
And so you saw that opportunity with Mike, and then you just jumped in and went full force, or how'd that work?
Yeah, I mean, it was, raising money back then was a challenge, because obviously, when things are bad, people think they're never going to get better. And then
a lot of negative news was out there every day. This bank shut down, that bank. Like every time I went to my parents, I didn't watch the news, but my parents were always on there. I'm like, I can't watch this.
Yeah, exactly. So it was a challenge, and it was on the heels of Bernie Madoff, his scandal, and then Scott Coles with Mortgages Limited had just unfortunately taken his life, and they had about $1 billion portfolfolio, and investors.
His father started that.
Yep. Yeah, he did. Scott definitely, ramped up, got a little bit more aggressive, in hindsight, maybe too aggressive.
Did you ever work with Shane Albers?
I know Shane, IMH. They had about $1 billion out as well. So.
Yeah, I went to visit Shane quite a bit, and Jerry, my mentor, he lived up in North Scottsdale, and a lot of his friends were retired executives at the time back in 06, 07, and Shane, he was well networked, so we would go sit in his office, and most of Jerry's neighbors had invested in IMH at the time. And
it's good, because we started, kind of at the bottom, like I said, so fortunately we didn't have to work through those years of, working through those bad loans.
Yes. Is that ever, go ahead. I'm sorry.
Yeah, but we definitely learned a lot, maybe as what to not do or how to do it differently. Because typically as private lenders and debt funds grow, the people managing those funds get sick and tired of making the $200,000-$300,000 loan, and they say, hey, we need to get chunks of money out the door, so let's do, 2, 3, 4, 5, 10, $20 million loans.
Interesting.
And that's, a lot of the loans that didn't go so well. I mean, the poster child's probably that Center Point project in Tempe that sat there, unfinished for years. But they were doing a lot of larger land deals, speculative land deals, bigger construction loans, bigger commercial deals, where what we do is we still focus on servicing the fix and flip buyers. So we're doing almost 95% of the loans we do on a monthly basis are fix and flip loans, and our average loan amount's about $380,000.
So what I'm hearing you say is you are very I call them the bread and butter deals, right?
Absolutely.
Like,
Yep.
That's what I always focused on. My fix and flips was bread and butter, bread and butter.
Yep.
And I was always like influenced, like, oh, why don't you do this luxury? And I mean, that just wasn't for me. I was like, let's just make a hit here and keep hitting the bases,
Hit some
single,
singles, hit some
double.
doubles. Yep.
And that's what I learned from my mentor too, because you have to have consistency and you have to get better at what you're doing. And I'm still getting better at what I do. Like I'm sure you're always changing and evolving with the marketplace.
Yep.
So you and Mike started that, and then when did you get into it full time, Noah? Because I started hearing your name maybe at some of the ASREA meetings. Like you were really like out there, like meeting people.
Yeah, I mean, I was working on it full time. It was just like I said, it was a little challenging to raise capital. So, we didn't want to market our services too much if we didn't have money. Because the worst thing in the world is, whether it's you saying, hey, I can buy your house, and then somebody calls you back and you say, never mind, I don't have any money to buy it. If we were marketing, hey, we have money to lend, and somebody reached out to us and we didn't have money, you mess up your reputation. It's a waste of marketing dollars. So it was a balancing act.
Was it kind of a gradual?
Yep. Yeah. So it was, all right, we'd raise some money, so we'd do a little bit of marketing, and then we'd raise a little bit more. So then we'd do even more marketing. And kind of the game changer for us was back in 2013. We were able to get a line of credit from Western Alliance Bank.
Oh,
which
is that a local bank? Or?
Yeah. So it's they're based here. Robert Sarver, the owner of the Suns. It's
gotcha.
The bank that he
based
started.
out in Arizona. Okay.
Yeah. So that was really helpful. That allowed us to have access to a little bit more capital. So then we could really start ramping up our marketing.
And that was in 13?
Yeah, 13. Yeah, so 13, 14 is when we really started trying to do a little bit more marketing and get the word out there.
Excellent.
Yeah.
So what would you say, Noah, to someone, because I use private money and hard money, but I don't know much about it. That's why you're here as the guest. And so what would you say to someone just looking to get started? Maybe they want to start their own private money, hard money. What would you suggest that they would do to get into that space?
Yeah. If you're trying to get into the space, I mean, the challenge is just that balance. You have to have money to lend, but you also have to have places to lend the money. So I think, a lot of times the challenge is just groups that get out there and, market their services too much and don't have money to fund deals. So it's really just trying to focus on both, not do too much of one, because you don't want to have too much money and not enough deals to fund, or vice versa.
That makes sense. So you went with Mike, he had the couple million, but at that time, were you going to family and friends, or how does someone even raise capital? You have to have a business plan, I'm sure, and present.
Yeah, I mean, for us, it was nice, and that's the other thing with people starting it. I mean, with any business, if you can go to a prospective investor with, a track record, or at least it doesn't have to be an overly extensive track record, but it's a lot easier to say, hey, here's the 10 loans we've done. here's the interest rate we got, here's the cash flow we received, here's how it performed, versus going to somebody and saying, hey, I got a brilliant idea, I got a brilliant plan, give me your money. And you would never say we'll work the kinks out with your money, but the investor kind of knows that the kinks will get worked out with their money. So yeah, if you can somehow bootstrap it,
That makes sense. So just test it, make sure that that thing works,
Yeah.
and then show them a track record. Like
Yeah.
you said, here's 10 deals we did, here's
Yep.
the money we made, and then from there, I think they're more likely to buy into
Yeah.
what you're basically your service, what you're selling.
Yeah. Any investor's gonna like to see actual deals you've done and a track record versus a fancy business plan, because everybody gets rich on paper.
Yes.
But it's when you've actually done it and can demonstrate that you know what you're doing.
So back in the day, it was 18% interest, right?
Yep.
Is that what
Oh,
you
yeah.
guys were getting on your money?
18%, nobody negotiated.
Yeah, here it is,
If there's
18.
money available, great. I mean, we'd get deals where somebody bought something for $300,000 and they wanted a $250,000 loan, and I'd say, I've got 200 grand available. It's
Take
yours
it.
if you
It's
want
like,
it.
yeah.
I'm literally that's all the money we have to lend right now. So yeah, there just wasn't as much competition back then. There was probably 4 or 5 groups that were doing it. There's plenty of private investors that have always and will continue
Sure.
to be out there. But yeah, so the industry's evolved significantly.
All over the country.
Oh, yeah.
So it's fascinating. So you were kind of early on in the industry, so once you decided to go to Western Alliance, was that just because you saw the spreads were going to work out as far as,
Yeah.
because obviously you have to pay them money, and then
Yep.
you make your money on the spreads. How did that all work out?
Yeah, so the line of credit, so before we had the line of credit and we just had equity that we'd raised from investors, we always had to keep, $2-3 million in the bank to be able to fund loans, which is a drag on yields because your equity isn't out 100% working. So once we put the line of credit in place, we could use that to fund loans, and when payoffs came in to pay down the line. So it helped with yields because we were able to keep our equity 100% efficient. And then on the line of credit, we get the arbitrage as well. 'Cause
Gotcha.
we're borrowing the money at less than we lend it at. So what it really allowed us to do was get more competitive with our interest rates, because we could still give our investors the same returns they were getting before, but we could lower our interest rate to make it more palatable to the borrowers. So it's always a balancing act. You got to keep your investors happy, but you got to keep your borrowers happy too. So
Yeah, that makes sense.
Yeah.
So was Western Alliance the very first institution, or did you go to others?
yeah, so we had a relationship. One of our investors who became a partner in Capital Fund One, the operating company, he was on the board at Western Alliance, so he was
Excellent.
able to go to Sarver and explain what we needed, why he thought it was a loan that they should consider. So it took
Did
a
you
little
guys
time.
kind of create that create that niche then, because they never dealt with
Yeah.
lending it to a hard money lender before? Huh?
Yeah, we were the first line of credit that they put in place for a true hard money lender. I think they'd done another facility for a group that was buying non-performing loans.
Okay.
But for an originator that was actually making retail loans to investors, we were the first one that they did, and they've grown that business. I think last time I checked with them, they've got $2.5 or $3 billion in commitments out just in that space, lending to other
That's
hard money
insane.
lenders.
Yeah. And so, did they give you a certain dollar figure?
Yep.
And then
Yeah, so we started with a $20 million credit facility.
20 million they
Yeah.
started you. That's amazing.
Yeah,
So
yeah, it was good.
Yeah.
Yeah, so the way those credit facilities work is you have to put up loans in your portfolio as collateral, and then they have
For security.
For security,
Okay.
and then they have an advance rate. It depends on the loan, but call it 70%. So if we put up a $100,000 loan, we can access $70,000.
Gotcha.
So we'd use our capital, make the loans, add collateral, and then be able to access more money to lend out.
Beautiful.
So
Beautiful.
yeah, it worked out well.
And were you able to what were the rates then? So you went from 18, did you change your
Yeah, so
interest?
over time, we brought our rates down to, we're at 18, then we're at 16, then we're at 14, then 12, and now, we're right in the 10% range.
Okay.
So yeah, over time, for us, we want to make sure that we're competitive in the marketplace. So probably not always going to be the least expensive. I mean, I'm sure you've worked with some lenders that'll lend you some money at a little bit lower rates. Some of them may not be as easy to work with us. I won't name names, but there's some national lenders
Right,
out there
yeah.
that can be maybe a little bit more difficult to work with. So we're not always going to be the cheapest. We're not always going to be the most aggressive, but we want to make sure that we're really
and what I
competitive.
like about working with you guys, Noah, is your the speed, the ease of
Yep.
use. Like
Yep.
it's not like draining on my time.
Yep.
It's like here's the property, and then
Exactly.
you have some paperwork we fill out, and then
Yep.
you're like, all right, here's our commitment. We'll
Yep.
do this much, and
Yeah.
boom.
Yeah, and we've built a good reputation because ease of the transaction, certainty of execution. When we say we're going to fund, we fund.
You do it, yeah.
We don't come back at the last minute and say, oh, investment committee said we got to increase the down payment or increase the interest rate, because that's just what kills your reputation.
So for you guys that don't know, you guys must be Noah's Group Capital Fund One is the largest in Arizona right now, or?
Yeah, I think as far as a local lender, I think we're probably one of, if not the largest.
That's amazing. How many deals, transactions are you guys doing like right now every month in Arizona? Because you're also in Texas and Colorado, I know you mentioned.
Yeah, so we've, COVID obviously was stressful for everybody.
Yep.
We didn't know if it was the flu or the Black Plague. We didn't know what was going to happen with the real estate market. But as we all know, it really just poured gasoline on an already hot real estate market. So we've grown really month over month since, call it June or July of 2020. So last month was a record month for us. I think we did 365 loans, originated about 150 million. This month, depending on what we close today, because today's the last day
That's
of the
right.
month,
Yep.
I think we'll fund about 420 loans and originate about 160, 170 million.
So these are record-setting months for you, it sounds like.
Yeah, so even, everybody's a little nervous, interest rates going up.
Yep.
I mean, as interest rates go up, obviously affordability becomes more of an issue. So there's not as many buyers. So your buyer pool is a little bit smaller. But there's still such a major supply and demand imbalance. I mean, I think 2 months ago there was 4,500 homes available, and we're doing 9,000 to 10,000 sales a month in Greater Metro Phoenix. So we had half a month's supply. Healthy is 3 to 5 months supply. So people are concerned, inventory is up 100%, which is still only 1 month of supply. So we really need supply to increase 3, 4, maybe 500% to be back to more of a balanced,
stabilized,
healthy market. So as long as that supply and demand imbalance remains, there's still going to be a decent amount of transactions because there's still people moving here.
Yeah.
People want to live in Greater Metro Phoenix and Arizona. So there's still a lot of buyers out there. So for that reason, I don't think appreciation is going to continue at 30%.
It's been,
it's been out of control, but we'll still see above average appreciation, in my opinion, for the next 12 to 18 months.
It's interesting because the guys in the trenches like you and myself, like we see it one way, and then you'll be listening to people that don't do real estate and they're trying to tell us like what's going to happen. I'm like, wait a minute, what are they like? I know they're economists, but like what's the real down and dirty of what we're doing here?
Yeah, and we're obsessed about digging into the statistics and looking at inventory and days on market and price points and Tom Ruff with he puts out the stat report. He's with Information Market. He does a good job of tracking, what are properties selling as a percentage of the list price. So, obviously that's been over 100% over the past, 12 to 18 months. So we're keeping a close eye on that just to kind of see.
To gauge it.
Yeah, to see that. So we're looking closely at that. Then we're obviously paying close attention to our portfolio and our business. And
Yeah, so
like I said, it's
tracking the data, watching
Yep.
Tom's
Yep.
projections, and just adjusting if you need to adjust.
Yeah.
Hey guys, quick announcement. I just launched my new Passive Income Accelerator course. In this course, you'll learn how I built my Airbnb portfolio to 10 properties and growing while amassing $3,000 to $5,000 per property per month. If you want to learn more, go to piaaccelerator.com/go and sign up for the early bird special. And now back to the podcast. Are you going to change up your interest rates based on inflation and stuff right now, or what are you guys thinking on that?
Yeah, we've made some small adjustments. I mean, again, we're in the private money space. It's become a little bit more standardized, but it's still not like the conventional lending space
Sure.
where as rates go up, everybody's rates go up.
Yeah.
So we're paying close attention to the market because yes, we should raise our interest rates, but if nobody else does and we become less competitive, then we're just shooting ourselves in the foot. So I had a conversation with somebody the other day. He asked if we'd raised our interest rates, and I said we hadn't yet. And he said, okay, well, let me get this straight. Everybody in the world is paying more for everything except your borrowers. And I said, well, when you put it that way, I understand what you're saying. So yeah, I think we'll make some small adjustments.
Eventually.
Yeah, but nothing significant.
Yeah, and what I respect and like about Capital Fund One is like, here's our program, you want it, or, I mean, I'd like to know what the program is, and I know what I'm working with then.
Exactly.
And there's no like, oh, here's a $200, I'll loan you if you want it. Like,
right.
It sounds like you've stuck strong to those principal values.
Yeah, absolutely. And that's another thing. I mean, with people that are in the industry or getting started, I mean, you definitely, with everything, including your lending relationships, you don't want to have all your eggs in one basket. Mm-hmm. You want to have relationships with multiple lenders because there might be deals that we really like, so we'll give more favorable terms. But there's deals for whatever reason we just don't like as much.
Yeah.
But another lender may like it a lot more than we do. So
yeah, and it's more like for me, like that's collaboration. Like
Yep.
I'd like that advice because realtors ask me that all the time. Like that's how I source a lot of my deals is through realtors. Like, am I the only realtor you're going to be working? Well, no.
That'd be silly.
That's silly. There's so much space. There's so many days. This day may not work for you, this loan, and it may work for Noah, but now it may not. So then you have to go to different private money lenders. So keep your options open, I think, is what Noah's saying. And, that's great advice. So the rate is under 10 right now, right?
Yeah, so on fix and flip stuff,
is it all fix and flip, or are you doing long-term stuff?
So we'll do, we'll do single-family residential, so we'll lend on fix and flips or rental properties.
Okay.
Typically, if somebody uses us to buy a rental or a vacation rental, they're going to use us to close quickly. Then they're going to refinance out.
That's what I did. That's what I did with my very first Airbnb I did with Noah. I did it exactly that way. Close quick on Bellevue. I don't know if you remember that. And then we, put a 30-year loan on there.
Yeah, exactly. So we're doing single-family residential. We'll do ground-up construction. We'll either do a one-off spec home or a small subdivision, small condo, townhouse project. We'll do other commercial. We'll lend on multifamily. We'll do office, industrial, retail, hospitality, mini storage. Then we'll also make some land loans as well, as long as it's to a builder or developer that has a clear plan. And typically they're just using us as a bridge loan until they get their construction financing.
Excellent. So what is from ground up? What's that like? Can you explain that to people watching?
So it's typically either somebody that is buying a lot and they want to build a spec house. So really the only type of loan that we won't consider is somebody that's going to live in the property. Okay. So if somebody's building it and they plan to move into it, we can't lend or
and that's because of the Frank law? Is that still in play?
Dodd-Frank Act. If you're going to live in the property, it's considered a consumer loan. On consumer loans, you have to prove the ability to repay, which means to do it the right way, we'd have to do a credit check. We'd have to get bank statements, tax
so that's
returns.
not really your niche.
We don't want to mess with that. And there's, you technically can't close a loan inside of, 2 to 3 weeks because of all the things that are required. So all our stuff, our average loan closes in about 3 to 5 days.
Beautiful.
So we're just set up to do the quick and easy short-term stuff. But on the ground up construction side, it's something where somebody either already owns the lot or is purchasing a lot, and they're going to build a spec home to build it and sell it for a profit. So on something like that, we're typically going to lend maybe 75 to 80% of total cost.
Okay.
So whatever your land cost is, your soft cost to develop the plans and get your permits, and then the hard cost to build the property. We'll typically look at what's that total number and lend 75 to 80% of that.
Gotcha. Is that, how is that percentage, like, is it mainly fix and flips that you guys are handling, or like what's the
So
percent?
right now in our portfolio, so we've got about 1,500 loans. We've got about 550 million lent out. As far as the breakdown of that, about 80% of that single family residential, then about 5% is ground up construction, 5% multifamily, 5% other commercial, and then about 5% land.
Gotcha.
So we're still real heavy in the single family residential fix and flip. But we'll look at all those different asset types. And then from a geographical standpoint, about 75% of our portfolio is here in Arizona, about 13% is in Colorado, and about 12% in Texas.
Interesting, because I know for myself at least, being grounded, like I'm learning the last 2 years of Airbnb business, so I'm doing it all in Arizona. Next year I'll probably go to different states, but I'm really trying to get everything I need to know. So when did you decide to move into Texas and Colorado for the fund?
So we started lending about 3.5 years ago in Colorado. So we just like that market. It's a growth market.
Yeah.
Had the
Is
same.
it Denver area? Or?
Yeah, primarily Denver area.
Okay.
But we'll look at other areas, Colorado Springs. We'll look at stuff in the mountain towns, but we're typically a little bit more conservative.
Good. Maybe we'll go to Colorado our next Airbnb then, because it's beautiful out there.
Yeah, it is. So yeah, we've been out there about 3.5 years, and then so we've got a sales office in Denver, and then we opened our Dallas office, I think 10 or 11 months ago.
Oh, so
we've been
in
out
Dallas. I hear that area is just, I've never done anything because I've always Arizona, but how's that?
Yeah, it's a real healthy market, lower price point than here, and especially in Colorado. I think our median home price now was it grown to around $400,000 here. Denver's about $600,000. Dallas is closer to $250,000.
Okay. So very affordable. It seems like in Dallas.
Property taxes are much more expensive out there. So if you look at buying a call it $1.5 million house here, and you're going to finance that.
Okay.
It really equates to buying maybe a $900,000 or $1 million house in Dallas, because once you factor in that the property tax payment.
Okay. Is Arizona one of the lowest property taxes in the country?
Yep. Yeah, it is. Yeah, I tell people from California or other places what my property taxes are. They're like, is that for a month or
exactly.
for the year?
Canadians used to ask me that too all the time. Like, how is it? I'm like, it's good. I love that factor.
Yeah, absolutely.
So for those who are looking again to start a fund or just raise some money, is there a lot of compliance things that you have to do as a private hard money lender?
Yeah, we do. I mean, every state's different. Arizona requires a banking or broker's license.
Okay.
So even if you're not making consumer loans, if you're lending, I mean, I think there's an exemption if you do 5 or less deals a year. You don't have to be licensed.
Okay.
So there's compliance with our licensing. We have to get the fund or the operating company audited every year. And then on the fund side, we've got a PPM, a private placement memorandum, and an operating agreement for the fund. We've got our Reg D offerings, so we're exempt from reporting to the SEC. But yeah, there is a lot of compliance. I mean, if you're just lending your own money, you don't necessarily need all that. But if you're raising capital from other people, you need to make sure that you're working with a a good securities attorney to
Makes
set
sense.
that all up.
Yeah. So setting up the structures, long-term success is
Yep.
definitely critical.
Absolutely.
So what new markets are you targeting in this year or next year? Have you?
Yeah, so
got
we've got our eyes on, kind of the usual suspects, Tennessee, North Carolina, Georgia, South Carolina, kind of the southeast. So those would probably be the markets we'd focus on getting open next, either later this year or early
Yeah,
next
I was
year.
out in Nashville not long ago, and I have some friends now that I mentored in Airbnb, and they're crushing it. But they're top realtors there, and that's a healthy market. It's a very
Absolutely, yeah.
Tennessee.
So yeah, we like I said, we like the growth markets. We like to diversify the fund a little bit with some other markets, but we need to make sure we've got people on our team that are experts in those markets, because we're an asset-based lender. So if we can't accurately value a property, we can get
For
ourselves
sure.
in trouble. Yeah.
So having the boots on the ground
Yeah.
experts is
Yeah.
critical to,
Yeah, 100%.
to success. So we're going to wrap up here shortly, Noah. Let me ask you this. Do you like what you're doing right now? Because I know there's people that do certain things in life and they don't actually like their job. I personally love my Airbnb and my coaching and all that. Do you enjoy what you're doing every day?
No, I love what I do. I mean, it's every day is a little bit different. There's always a new challenge. But yeah, there really hasn't been a day
That's
over
amazing.
the past 14 years that I've woken up and said, ugh, gotta go to the
Right.
office.
Got to
today."
get into that
Yeah,
office.
no,
Like,
I do love it.
and that's where you step out on a leap of faith if you're just starting and you have to create something that you want to go do every day. If not, for me at least, why are you doing it? Like,
Oh, yeah.
life goes so quickly.
Yeah, life's too short to do something you don't enjoy.
So that's awesome. And seeing your success and seeing things done the right way, that's where growth happens. And
Yep.
again, having the mentors around you to steer you from explosion, like, or how do we figure this challenge out?
Yeah,
So
yeah, absolutely.
I learned a lot about that. So I heard you say a few things, Noah, for those viewers. Again, the program's called Cut the Curve, where we interview moguls, mentors, and entrepreneurs, trying to shorten the length of their learning curve. What are like 3 hacks or 3 tips that you would share with folks out there in concluding?
Yeah, I mean, I think definitely having a good mentor. I mean, there's a lot of people out there. I mean, I think I've liked to see over the past couple of years that I feel just in general people get along better in the industry. People are more helpful.
More collaboration is going on now. I'm like, holy cow, this is beautiful.
Yeah.
It's not like cutthroat competition anymore.
And it all comes down to having an abundance versus a scarcity mentality.
The mindset. So mentor.
Yeah, find a mentor that has that abundance mindset that wants to collaborate with other people. I mean, like I said, there's a lot of great ones out there. Talk to a few of them. You may get along better with one.
Yeah, see what works for you.
Yeah, so definitely have a good mentor. Networking is huge. You just gotta get out there. I mean, you might be uncomfortable at first.
I remember I was like, I don't want to go tonight.
You feel like you might not know the right questions to ask, or you might not have the right answers. But again, the overwhelming majority of people are going to want to be helpful. So don't think that it's going to be a difficult conversation. Just go into it, have the conversation, learn from it. So yeah, networking, and then definitely diversifying your relationships, like we talked about, whether it's with realtors, lenders, title companies. I mean, most of us have kind of our go-to person, but you want to make sure that if something's not working out with that go-to person, you don't have to spend 2, 3, 4 weeks trying to find somebody else. You already have.
For sure.
You already have somebody else that you can quickly go to.
Yeah.
So yeah, I think diversification of your relationships is important.
Love that advice. And there was one thing I was going to mention to you. So with the collaboration, like if you can't do a deal, we know we got someone that will, and you're not hurt either. Business is business. You're like, oh, Flip, I can't do that deal today, but hey, Bob will help you out, or here, Bob, you want that deal?
Yeah, and we do, so we track our conversion ratio. So our conversion ratio is typically 40 to 45%. So if we look at 100 loans, we're going to fund 40 to 45 of those.
Yeah.
So we don't want to fund every loan. We don't necessarily want to fund every single loan for one borrower.
Sure.
So yeah, it's important to have those other relationships.
Yeah, that makes a lot of sense. Finally, one thing that you said that you and Mike did early on is show a track record. So if I'm going to you for anything, and you have to, as being the mentor, those people have to want it more than you want it as the mentor. So come up with a business plan, show it to your mentor what you need help on specifically, and then you know that they're having thoughtfulness behind where they want to go.
Yeah.
Right?
Yeah, and even, if you want to get into fix and flipping and maybe you don't have capital or don't know where to find the capital, find a mentor and just say, hey, let me do whatever you need on this deal. Like,
yes,
just to be part of it.
value.
Yeah.
Provide value. We know you're just starting, but you have time, you have energy.
Yep. And you'll learn a ton.
And you're willing.
And for us, we ask borrowers for past projects, even if they haven't necessarily owned the project, but they've been involved in it, we see that as a positive.
Yeah, so that shows a track record.
Yep, absolutely.
Excellent. Well, I learned a ton today from Noah, and I hope you guys learned a ton also, and I really appreciate you being here, brother.
Yeah.
We'll have to go shoot some hoops one day soon when we get some more time.
Yeah, absolutely.
All right.
Thank
Thanks
you very
for joining
much
us on Cut the Curve, brother.
Absolutely.
Appreciate
Thanks, Flip.
it.